Mortgages are typically the longest and largest loan that someone will get. It's a huge commitment. Before getting a mortgage, it's best to learn as much as you can about the ins and outs of a home loan. And that's what we're going to talk about today. There are 4 parts to a mortgage payment. The acronym PITI is typically used to remember each part. First, there's principal. That's the P. This is the amount that you're borrowing. So if you're buying a home for $220,000, you're putting $20,000 down. You're borrowing $200,000. That $200,000 is the principal. Then there's the interest. Interest is the cost of borrowing. This is how the bank makes money. They let you borrow the money and the bank charges you interest. Your interest rate is determined by a lot of factors. Some of these are out of your control, like the Federal Reserve, the bond market, the treasury rate, the state of the economy, inflation, and a lot more. Then there are things that you can control that affect your interest rate, like your credit score and how much money you're putting down on the home. The higher your credit score, the better interest rate you can get. To get the best mortgage interest rates, you want a credit score of about 760. Also, the more money you put down, the more invested you are into the property and less risk the lender is taking on, so that could also reduce your interest rate. As of this recording, interest rates are currently pretty high historically speaking. Interest rates are the highest they've been in about 20 years. They're currently around 7%. But to put it in perspective, in the 1980s, the interest rates were as high as 16%. Now, the median home price back then was $47,000, so it's a completely different story. But regardless, the 7% interest rate and some other factors have made housing affordability very difficult, aka unaffordable. That's why it's important to work on your credit score and save for a down payment to get the most favorable lending terms. Now on to the T of PITI, and that's taxes. It's important to know that property taxes can change. They're based on the assessed value of the home. If you're getting a mortgage, the lender usually has you pay them money for your property taxes. Then they use that money to pay the tax bill when it's due. Then the second I in PITI is insurance. There are 2 types of insurance. There's homeowner's insurance. Most mortgages will require you to have homeowner's insurance. This protects you and the bank's investment. If something major happens with the house, like a tree falling on the house, then insurance will pay to repair the home after you pay a deductible. A deductible is a predetermined amount of money that you pay out of pocket before your insurance coverage starts sharing the costs. Then the other insurance you may have with your mortgage is mortgage insurance. Mortgage insurance is a type of insurance that protects the lender if you default on your mortgage. You'll have mortgage insurance with a conventional loan that has a down payment less than 20% and with an FHA loan. USDA loans and VA loans have a mortgage insurance equivalent. I'll talk more about that later in the video. If you need help finding a real estate agent, I can help you. The link is in the description. Also in the description is a link to my free homebuyer course. Now let's talk about the different types of mortgages you can get. There's a fixed rate mortgage, which is what it probably sounds like. The interest rate remains the same or fixed for the life of the loan. So if you have a 7% fixed interest rate, it will always remain 7%. Then there's adjustable rate mortgages, which people sometimes call ARM. Adjustable rate mortgages have a fixed rate for a specific period of time, then it adjusts. The adjustments are based on some of the factors we talked about earlier that affect interest rates. Let's break this down a little further. You may hear someone talk about a 5-1 ARM or something similar. So what does that mean? A 5-1 ARM means that the interest rate is fixed for 5 years. Then after 5 years, the rate will be reassessed every year after that. They can be different increments. 5-1 is just an example. So what's the benefit of doing an ARM loan? It generally comes with a lower interest rate than a comparable fixed rate mortgage, giving you lower monthly payments, at least for the fixed period of the loan. These ARM loans were more popular 20 years ago. As the interest rate lowered, we didn't see ARM loans as much. They're starting to make a bit of a comeback. ARM loans can work if the interest rate lowers before your rate starts adjusting. At that point, you would refinance to lock in a lower fixed interest rate. Interest rates are pretty unpredictable, especially right now with the economy being so uncertain. If you're going to do an ARM loan, you want to proceed with caution because it can be a bit of a gamble. You may save in the short term, but could end up paying more in the long term. I'll give a quick overview of the most popular loan programs. I have other videos that go into them more in depth. First, there's the FHA loan. It's insured by the Federal Housing Administration. This is a loan that's commonly referred to as a first-time homebuyer loan. It's actually open to people that have owned a home before as well. The FHA loan allows for down payments as low as 3.5%. This loan is helpful for people who have lower credit scores and not a lot of money saved up for a down payment and a higher debt-to-income ratio. The FHA loan has mortgage insurance that lasts for the life of the loan if you put down less than 10%. Then there's the VA loan, which is insured by the Department of Veteran Affairs. It does not require a down payment. There's no mortgage insurance, but there is a VA funding fee that you pay. There's also the USDA loan. This is backed by the Department of Agriculture. This is also a 0% down payment loan. You're limited to rural areas and specific income allowances. There isn't mortgage insurance, but there can be a fee for some USDA loans that is equivalent to mortgage insurance that stays for the life of the loan. However, this fee is a bit less than the mortgage insurance you pay for on an FHA loan. Then there's the conventional loan. This is what some people may consider a traditional loan. You can put down as low as 3%, sometimes less in certain scenarios. If you put down 20% or more, you won't have mortgage insurance. Usually once you reach about 20% equity in the home, your mortgage insurance is removed from a conventional loan. The conventional loan is a little bit more flexible than other loan programs that we talked about. There's a couple of other loan programs like jumbo loans and interest-only mortgage. These are usually used by people who aren't first-time homebuyers, so it probably doesn't make sense to go into detail about these kinds of loans. Just know that there are other options out there. They can be a bit more advanced, so to speak. Something that's becoming popular right now with the high interest rates is a 2-1 buy down. This is a mortgage agreement that provides a lower interest rate for the first 2 years of the loan. So let's say you get a mortgage with an interest rate of 7%. With a 2-1 buy down, the first year of the mortgage, the interest rate would be 5%. Then the second year, it would be 6%. Then the third year and every year after, it'll be 7%. This is a way to lower your mortgage rate temporarily. Some sellers have been offering a 2-1 buy down to entice buyers to buy a home. This can be helpful to lower your monthly mortgage payment, but again, this is temporary. This is why it's ideal if you can have the seller pay for it. A reason someone may do a 2-1 buy down is because they think mortgage rates will go down within the next few years, so they can have a lower interest rate now, then refinance when the rates go down. Hopefully before you start paying your full interest rate. Obviously, it's a little bit of a gamble because we really never know what interest rates might be in the next couple of years. Another term you may hear when talking about mortgage is points. Mortgage points, also known as discount points, are fees a home buyer pays directly to the lender in exchange for a reduced interest rate. This is also called buying down the rate. Essentially, you pay some interest upfront in exchange for a lower interest rate over the life of your loan. Why someone would do this is to reduce the monthly mortgage payment because your interest rate will be lower. Long term, you could save thousands of dollars. Let's break it down a little further. Each mortgage point you buy costs 1% of your total loan amount. So if you're getting a loan of $300,000, a mortgage point would cost $3,000. One mortgage point is typically equal to 0.25% of interest. So if you buy 1 point for your 7.5% interest rate, your new interest rate would be 7.25%. This would be for the life of the loan. In this example, you would save about $50 a month on your mortgage payment. If this was a 30-year loan, you would save about $18,000. So if you are going to pay for discount points, you want to stay in the mortgage for a long time. In this example, you would have to live in the home for almost 5 years until you would break even on the discount points you bought. So if you refinance, you would lose those points. I recommend doing your research before buying points to make sure it's the best fit for your situation. Sometimes investing that money in the down payment could be a better idea, or just saving it for something else. Talking with your lender can help you decide which scenario would be best for you. A mortgage rate lock is a tool that allows you to lock an interest rate in place for a set period. I usually see the rate lock period being 15 to 60 days, but this can vary. A reason why you would lock your rate is because interest rates fluctuate. They can change every day. It makes sense for you to lock in your rate. But there are some things to know. A rate lock will usually cost money. It's typically about 0.25% to 0.50% of the loan amount. This is usually a part of your closing cost that's charged by the lender. If your loan closing is postponed for any reason, you can usually extend the lock period for a fee. Say you lock in a mortgage interest rate of 7% for 30 days, and after 20 days, rates spike to 7.5%. You're still entitled to your 7% rate, which will make your mortgage more affordable in the long run. Basically, a mortgage rate lock protects you from rising interest rates. One of the things to ask about when you're choosing a lender is about how the rate locks work. How long are they? How much do they cost? How much does it cost if I extend the rate lock? All that kind of stuff. Now on to mortgage amortization. In real estate, this is the process of paying off your mortgage loan with regular monthly payments. These payments are made in equal installments over the life of the loan, but the amount of the payment consisting of principal and interest can vary. So this is what this means. When you first start paying your mortgage, you might pay more interest than you pay on the principal of the loan. It can take many years until you're actually paying more on your principal than the interest. This is done so basically banks can make their money on your loan. There are amortization schedules that you can look at online to get an idea of what you might pay in your situation. Loans can last different amounts of time. The most popular nowadays is probably the 30-year loan. The 15-year loan is also popular, but a little harder to do nowadays. The reason you would choose a 30-year loan is because your monthly payment would be less. The benefit of a 15-year loan is usually you start paying more into your principal than your interest. Ultimately, you save money by doing a 15-year loan over a 30-year loan because you're not paying as much interest. There are also 10-year loans and even 40-year loans, but of course with a 40-year loan, you'll be paying more interest over time. But in the short term, your monthly payment will be less. With all of these different options, it makes sense to talk with multiple lenders to find out who can provide you with a loan with the best terms. If you want to learn more about different types of loans, check out this video or this playlist about other loan programs. If you have any real estate questions, my contact information is in the description below. Thanks for watching to the end, especially if you're a subscriber.